Hello and welcome to the i3 podcast. My name is Wouter Klein and I'm the Director of Content for the Investment Innovation Institute. For more information about our educational forums for institutional investors, please visit our website at www.i3-invest.com. There you can also subscribe to our complimentary newsletter i3 Insights, in which we discuss investment strategy and asset allocation questions with asset owners around the world. Now, as you all know, we love our disclaimers in this industry, so here's ours. This recording is for educational purposes only. It does not constitute financial advice. Please enjoy the show.
Welcome to the i3 Insights podcast. My name is Daniel Grioli and I'm the MarketFox columnist for i3 Insights. Today I'm joined by Alva Devoy. Alva is the Managing Director of Fidelity International's Australian office. She's spent over 20 years working in a variety of capital markets and investment roles in Australia and Europe. I'm looking forward to chatting with Alva about what it's like to run an asset management firm, the pros and cons of large investment firms versus smaller boutiques, and the future of active management. So without further ado, I'd like to welcome Alva to the podcast. Alva, thanks for joining us today.
Thanks for having me.
I've been looking forward to this for a while, particularly asking you about your background because it's quite interesting. How does somebody with a doctorate in molecular engineering get into the investment business?
There is actually quite a neat common thread, and research is the key. So in doing a PhD in molecular engineering, genetic engineering, I spent many years researching at the bench for a final outcome, and I worked in applied sciences. So I was actually delivering a vaccine. That was my PhD thesis. And if you can research in one milieu, you can research in another. So that is the common thread. The next question is why move from an engineering background into finance? And I think it's personality driven and interest driven. So I was doing my PhD during the first Iraq War, and let's say the 92 timeframe around Desert Storm, etc. I would be reading financial press avidly, effects on oil price, defence spending, etc., etc. And coming into university and wanting to talk about it to a bunch of people who had absolutely no interest in the outside world, going from my professor all the way down to my peers. And I think it was at that juncture, combined with the necessity to continuously repeat experiments to make sure you got the same result, that I decided I was in the wrong pond. So I suppose it trip switched the fact that I was much more interested in going outwards with my knowledge and learning more about, I suppose, the global economic environment, politics, the sociology of economics, etc., rather than getting to know more and more about less and less and becoming an expert in a very narrow, small field.
It sounds almost like you got a bit bored with working in a controlled environment and wanted to experience a more uncontrolled environment, such as financial markets.
Yeah, I guess you could say that. And I moved from being an analyst on a sector where I did move from known to unknown, but then became a technology analyst just into the dot-com boom, but found after a period of time that I was mirroring my experience at the bench, in that I was getting to know more and more about less and less. And also I would go out as a stockbroker at the time to asset managers and talk to them about which stocks they should buy, but then I couldn't contextualize the decision for them on the other side, which stocks they should sell, what that would mean for their sector weighting, how that affected, or linked in with their macro view, etc. So I decided, to move at that point across to asset management, and worked my way through managing funds all the way into probably the least controlled job of all in markets, which is the market strategist. Because as a market strategist, calling the markets, looking at the influence of both economic growth, but also sentiment, etc., you are standing on quicksand. You are never on firm ground. And that's probably the most uncontrolled of all of the environments that I've worked in.
Mm-hmm. It's interesting to hear you say that. I was thinking as you were talking about how you've come in from a very different background to most people.
Yeah.
What struck you about the way people did their research?
Yeah. The really interesting thing to me was that insights could come from anywhere. And, you know, there was that big window on the world, if you like, access to expertise. You could go and ask people questions, be it the company management, the people they were selling to, those that were buying the products, etc. And all of it was valid research, but it's all very much up and out there, as opposed to, you know, working at a bench where you're designing your own experiments, working them through so you get an actual result and then a repeatable result to make sure it's statistically significant. So that, I guess, harvesting of information and harvesting of intellectual property started a huge love affair of mine with intellectual property, because it comes in many forms. My first role was actually to go in and work on pharma companies and pick apart clinical trials. So that first piece of work, if you like, I was learning from a very seasoned analyst who was not up to speed on the pharma sector. So she taught me the accountancy, the valuation methodology, the rigor and that side of it, while I taught her about drug science, clinical trials, etc., probabilities, and then all the way through to monitoring competing molecules, if you like. So it was a very neat reciprocal arrangement for a period of time, and then I went on to do technology research and become a tech analyst.
Sounds like you were able to help each other. So how long do you think it took before you started to feel comfortable with the numbers aspects of equity research?
I'd say very quickly to get the numbers piece, but then, you know, lots of people can build models. Where is the true value in that? For a period of time, I thought there was a huge value in building models, getting my models right, you know, being, you know, crystal clear on everything being connected. But I actually, you know, and that's good when you're getting up and started. You need to build your confidence. You need to be able to stand over your numbers. You need to be able to give a recommendation. And at that point in time, I'm in as small stockbrokers in Ireland, putting a buy-seller hold on stocks and going out and pitching it to clients. So you need to be absolutely across your numbers and your rationale. I guess what I didn't realise, and it has resonance in today's world because we're 10 years on from the GFC, is I hadn't been through a cycle. So if you think about it, late 90s, putting a buy on a tech stock, everything was going up, you know? So for a while you believe your own crap, quite frankly. And it isn't until, you know, you do hit a cycle and you've got skin in the game, you know, money because you've bought these stocks, you know, you're into investments yourself. You don't know what it feels like. That's the other side of it. So I remember I had a price target on one particular stock, an Irish tech stock, at $110. It was listed in the US. And I was in asset management a number of years. And one of my peers, my colleagues, found that report many years later. I think the stock was at 10. So, you know, it's a humbling experience because you've put your name to something, you've gone out into the public domain. But even more humbling is when, you know, you lose money on behalf of clients, and that's something you never want to repeat.
Sounds like you had a couple of lessons learnt the hard way, which I guess all investors have to go through. Mm-hmm. You mentioned earlier that your career progressed through various stages where you were specializing in healthcare and then technology, and then finally becoming an investment strategist, which in some ways you can't really call a specialization because it's much broader. And that also introduced a lot of uncertainty. Did you have to change the way you did your work cope with that? Or
yeah, as an analyst, your toolbox is your modelling, your P&L, cash flow, balance sheet. And there's a reason why I guess analysts spend so much time on their models. It's like a security blanket. It's a safety zone. And for those who become career analysts, that safety zone is really, really important. They like being expert in their field. They love the fact that they have to predict quarterly earnings or half yearly earnings in the Australian case. But, you know, there's a sense of security around knowing the company, either knowing the managements very well, but also knowing the cycles of the business as well. And to step up into a zone, I had been a macro-based investor, so it wasn't completely unfamiliar. I'd, you know, come into my own through managing money as from a macro lens. To step into the zone where the data is the data, and you have to have a healthy level of cynicism to a degree around the data feeds that are coming through. And the real art is in the connecting the dots. The real art is pulling apart the whys behind a particular data point or a trend line on data as well, but really moving into from one dimensional / two dimensional as an analyst to really three dimensional thinking as a strategist, questioning events in markets, questioning the domino effects that are still coming through events, you know, probably 3, 4, 5 years later. You know, we could take the GFC as an example, all the way through to connecting the dots from disparate pieces of information to paint a picture. So completely different.
one of the things that I found in doing strategy work, and I'd be interested to hear if you experience something similar, is that you've got to develop a sense of the perversity of markets, because markets often don't behave in the way you think. You know, good news can sometimes be bad news and vice versa, depending on what expectations are already priced in. So that was something that I found challenging at first, was getting to grips with that perversity, and also sort of always having in the back of your mind that it can happen, and sort of allowing for that in your strategy work. Is that something you found? Or?
Absolutely. And you're all the time, if you have a level of humility to you, you're all the time looking for what it is that you're not seeing and what you're not understanding, because you take information as it stands today. That's the best lens that you have. You make your connections, you paint a picture. That's usually predicated on, a fairly sensible framework, either, the business cycle or the investment clock or whatever it is that you subscribe to, or valuation metrics, etc. But what I found the best help to me in terms of keeping a weather eye on and being aware of the areas that I may not be picking up on was conversations with clients. Because one of the most attractive things about working in markets is we're working with very intelligent people. I was servicing clients, including Fidelity at that time. I would come in and talk to Paul Taylor and Kate Howard. I was servicing competition, Schroders, Martin Conlon, and all those guys there. And it was the conversations that I had with them that was sometimes trip switch. I didn't think of that. I didn't see it that way. Or one particular conversation I can remember having with Martin in particular, where he said, "You just look so downhearted." And it was a situation where we were calling everything right on the data, and markets were, behaving completely the opposite to what we had expected in terms of asset prices, etc. And you kind of go, but I'm getting it all right, but the market reaction is completely counter. So yeah, of course you go through zones like that.
Okay. I'd be interested to hear about any mentors or people that you found influential along throughout your career. Were there any mentors that stand out?
I suppose I have to start with my parents, and my father in particular, who I come from a very working class background. My dad was a baker and my mum worked in a bakery. And their, I suppose, ticket for their 2 kids out of where we lived was education. And by hook and by crook, ended up getting myself and my sister Laura fantastic educations, and she has a financial services career in Ireland currently. But that, I think, the power of education and the power of learning has never actually left. And the way that I learn and continue to learn is a lot of it is through conversation. It's connectivity with people who are very, very different to me, who've different backgrounds, but also really importantly, that cognitive diversity. They think differently, think outside the square. You know, I'm a scientist, I'm an engineer. I think quite logically, but I do think in the round. So that's helpful. I pepper my learning by talking to demographers, you know, anthropologists and people, management consultants, etc., who just have a different lens. In terms of mentors, there were ones in the industry, but one to mention probably outside of the industry is my cousin Brian, who I believe in all careers you have to do an apprenticeship. And in that apprenticeship, you probably are a dog's body. You probably are working 70, 80-hour weeks for a period of time until you perfect your craft. And that is just life. And for those who have ambition and want to be good at something, you just got to get in all heart and get on with it. But you do have to be mindful of your health on one hand, or otherwise you don't have longevity. And you also have to be very careful of self-actualising as well. That in being ambitious and in doing well in your job, you don't lose sight of all the other facets of your personality that need to be fed as well. And if you take a step back and make sure that they are fed, you end up a very rounded, resilient individual. And I think that's worth its weight in gold in today's world. I guess within industry, I've had some wonderful bosses, and one in particular stands out, Randolph Clinton, who I worked for at RBS and then CIMB in investment banking, purely because of, you know, a maniacal focus on results, but definitely a coach style leader, and could build superb teams and taught me how to do that.
It sounds like your parents set you a great example, which was a big part of setting you on the right path. And you mentioned also the importance of learning, which is something I'm going to ask you about a little later, because that seems to be a trait common to most good investors, the desire to always keep learning. So you've had this great career where you've worked in Europe, you've worked in Australia. What do you think are some of the similarities and differences between capital markets and investment business in Europe and in Australia?
I guess it's easier to pick the differences, and they're on a couple of different levels. I think working in Australia, we have to work way harder at pulling the information to us. You have to go hunt for information, for stories, developments within markets, etc. And it's very easy with the tyranny of distance, I guess, to miss nuanced changes in investment markets, pieces of information, etc. Whereas I found working in Europe, it's a massive push towards you. You're picking up information all the time by osmosis because the newspaper headlines were there, TV, etc. It's in the heart of, you know, financial markets in real time. And so that was a huge difference to me coming to Australia, where I've had to set up my own infrastructure so that I do, I suppose, you know, throw the net wide and capture the information that I need. I do think that we underappreciate various structures in Australia, and we probably do ourselves a disservice here. And I say us because I'm an Australian citizen now. So coming into Australia, I knew about superannuation. It was one of the reasons I moved here, because I wanted to be part of a growth industry. And I completely underappreciated the RBA in particular. I think in the Royal Bank of Australia, we have amazing stewardship of monetary policy set appropriately for this economy by some outstandingly intelligent and very you know, people who see their careers as vocations, the stewardship of this economy and the monetary policy. I think we underestimate the power of superannuation and what it has done for society here in the level of sophistication around money. And I also think we underestimate the power of the controls around immigration for this country. And I know it's a very hot potato of a political topic, but I'm talking about it more in the sense that from a Department of Immigration perspective, the way that we can use the ebb and flow of labour to the advantage of this economy is incredible. Because if you think about the heady days all the way up to 2012, and we've got, resource mega boom happening, mining capex, we needed so many, workers to come here, and it was literally was just come on board. Then things started to get a little bit wobbly around about August 2012. And all of a sudden, the visa program switched to, well, you can come to work on specific projects. And once those projects are over, you must leave. To basically a hiatus period on 457s, while we moved labour from the mining capex boom back to the eastern seaboard to residential non-resi construction. So we've had, a peak in unemployment here through that shift, probably my mind wants to say 5.6%, which is phenomenal.
Thereabouts,
yeah. So those are, I suppose, the standout differences to me. And then similarities are, I guess the things that I guess to take a step back, when I came to this country, I thought, I'm just going to be a hotshot because I've got, US equity expertise and I've got European equity expertise. And, I'm going to sail straight into a job and I'm going to be fabulous. And, I came up against the most amazing investors here who, put me up against the ropes in my job as a market strategist, but elevated my game, on the other side of it. So, the actual investment expertise in this country, again, is phenomenal, and probably don't shine a light on that too terribly often.
I think there's a lot of people here that have worked overseas at one point or another in their career. And so they've brought back an eclectic mix of skills and backgrounds with them. And I think in some ways, being an Australian investor, and I think the same is true of other small open economies, you by nature, you have to be much more globally focused. I think US investors can in some ways become a little lazy because they're 60% of the world market cap. They don't really have to worry about currency because they're the reserve currency. Whereas for us, you get a currency call wrong, you can
torpedo your
results, can destroy several years of gains on the rest of your portfolio. So I think being a small player in a global economy kind of forces Australian investors to have to think globally in bigger picture. So as you've mentioned, your career's progressed through these various stages, and part of your career has been responsibility for different teams. Now you're responsible for Fidelity's Australian team. So as somebody who's had various leadership roles in financial services and investment businesses, what advice would you give to somebody who's starting out in their first leadership role?
2 pieces of advice. Make sure you know your industry inside out and back to front. And the really interesting thing about that piece of advice is you will be moving into a leadership role because you've demonstrated a level of expertise. You've probably, either been a hotshot salesperson or you've managed a big project, etc. But I find if you've been in an industry a long time, sometimes you don't take the time and make the effort to get off the hamster wheel, to stand back and look at what's really, really going on. Because a lot of us get on the hamster wheels, we deliver within our remit, you hit pay dirt, you make your bonus, you go on to the next year. And by stepping off the hamster wheel repeatedly through your career, but most especially as you move into a leadership role, and taking a balcony view, if you like, looking front to back on the industry that you're now leading in, I think is really, really important, in part because you have to set the direction. And if you're setting the direction predicated on, past experiences and where you've come from, That's just your experience within your realm. So the best way to get a different view is get out and talk to people and really excavate your industry from a market's participants' point of view across all areas. And I've done that, even though I've been in this industry over 20 years and I've been in Australia 9 years. When I took over managing Fidelity a couple of years ago, I just got out and talked to people. You know, what are you needing? What are you struggling with? What are you seeing? What are the changes that are going on in your business, to paint a fuller, richer picture to allow me to set direction for our business? So that's probably the main piece of advice. The second piece of advice is, in taking over a team, do not transfer your view of success onto the people that you're managing. And what do I mean by that? You know, my view of my success is a particular vision, you know, of what I want to achieve. And I was happy to move around the world and change countries in order, you know, to move up and learn, be learning all the time and learn about new economies and new markets. That isn't everybody's definition. And when you take over managing a team, have the humility to sit down with each of your team members and ask them what drives them, what their role is to them, what they're doing in their day-to-day role to achieve the outcome of the company, and listen to how they see it. And then listen to how they see their careers unfolding and what their aspirations are, without transferring your own assumptions.
I couldn't help thinking when you were talking about the need to get out and get perspective about what's implied by that statement, which is if you're going out there and getting perspective, you can't be micromanaging your staff.
Yeah.
You can't be in two places at once.
No. So that's where hiring, you know, I would see my job, a huge part of that is hiring the right people with the right skill sets into the right seats with the right attitude. So there's 4 components in there that all have to be correct. And then when you've got that in place, what you can achieve together is absolutely phenomenal. One of I think the most important things to realize about leadership in today's world is it has shifted enormously. And I don't know that we've actually focused a lens on this. You don't become a leader anymore just because you're a subject matter expert. And probably, you know, you're not a subject matter expert, because it is very, very difficult to be across all components that fit into making a really successful business. As a leader today, what you are doing is harnessing experts, because you can't know it all. What you are doing as a leader is allowing yourself to be reverse mentored by people way younger than you, with very, very different degrees, coming in to help you express and realize your vision for your business. So there's a level of humility to that. And I talked about the team, hiring the right people, and making sure they're in the right seats. A lot of leadership today is to use General Stanley McChrystal's lens. He wrote the book Team of Teams.
I actually heard him speak at a conference.
There you go.
It was very good.
Pretty inspiring individual.
Definitely.
So his view is leadership today is actually about gardening, that you pick the right seeds for the right conditions, you water, tend, nurture, and then you get out of their way. So he found he was, part of the US coming good in Iraq and Afghanistan as part of the surge, etc. That when he had the right teams doing the right thing in the right places, they were still waiting for him to give the okay on particular activities, etc. So he was like the cork in the bottle. Whereas these guys were on the ground, in the thick of it, and well equipped to make decisions. So he took himself out of the field. He gave them power on the ground, in situation, to make the right call. And that's a hard thing to do. When your success within the business is around people delivering for you, to your point around not micromanaging, taking the step back, trusting, empowering. And then when things go wrong, pulling it apart to get the learnings without blaming. And this is where I think military culture has a huge amount to offer us. You know, it's not necessarily intuitive, but if you were to read books on the Navy SEALs in particular, they have, you know, a collective ownership as groups. If they go into an environment, into a particular task, and something happens or screws up, from, you know, the top down, the leader owns it and protects his platoon, etc. But they learn from it. There is no blame exchange.
It's very interesting to hear you bring up General McChrystal. When he spoke at this conference that I attended, he made the point that communication was a big part of bringing together the different teams that he had to work with. And there was quite a bit of debate when they started what turned out to be a huge meeting where all the bases would actually come together once a day and exchange information. There was a lot of fear at that point. He made the point that there was a lot of fear that the enemy would be able to intercept a large part of the communication. And so people were worried, you know, if we let too many people in on the plan's going to get out. And what they realized through the process, and I think this is true in business as well, is that the risks of information getting out
is
worth bringing people into the plan and empowering them.
Yeah, I'd wholly agree with that. But fostering, you know, that forum and that safe environment for transfer, not just of information, but back to intellectual property, of know-how, experience, you know, shared experiences sometimes. That is a huge part of what a leader does. And, you know, I'm working in Melbourne today to figure out where the gaps in our connective tissue are, because we are going through a growth phase. We've hired a large number of people. We're bedding in and consolidating. And now it's around getting the supporting infrastructure around everybody so that they are set up for success.
Sounds like an interesting challenge. I'm sure you would have seen this through your career, that some of the best investment professionals can sometimes have very big personalities. We use big as a euphemism. You can fill in the blank. Mm-hmm. How do you create and maintain the right culture in an investment team? And also, how do you motivate and retain staff?
Alignment. It's you know, whether it's a big personality sales guy on a trading floor in broking, or it's a big personality PM managing money. I think keeping everybody aligned to a common end game, which is ultimately in asset management, generating better futures for clients, keeping that line of sight front of everybody's mind, and making sure that the transparency between business, who fronts, you know, the salespeople who front out to clients, and the PM who is basically manufacturing returns for the clients, is hugely important. The incentivization structure is very important on both sides, but also the KPIs that are delivered to a portfolio manager has to line up with the distribution side. So, you know, for us, generating alpha is primary, but it's not short term. You know, we are rewarding our PMs over a 3 and a 5 year time horizon, because we believe that's in the client interest. We believe that, you know, short-termism, there's already enough of that in stock markets as it stands, if we were just to look at equity markets in particular. We need to negate for that noise. We need to think about the longer lens, the rolling performance. Also, to, you know, to the point around manager skill, that, you know, time and time again through cycles, different conditions, that you can generate that outperformance, and that it is idiosyncratic. So we will pay for that. We will pay handsomely, and that's ultimately aligned with the client need at the end of it. And I think then in terms of helping portfolio managers mentor other PMs and mentor analysts, again, you have to, you know, make it in their interests for them to share their intellectual property, give of their expertise and their experience, especially to the younger crews coming along, and that is part of their KPIs. And nowhere is it more important probably than now, which we're 10 years on from GFC, and there are a lot of people in this industry who do not know what the GFC was or understand what that felt like. So that's particularly important today.
Okay, so you've got the incentive structure right, and you've got the KPIs right, and you've got this interchange of knowledge and ideas. What does that look like?
I think a mirror of the fact that we're living in an ecosystem, that everything is an ecosystem. So if I was to take, it right down to the granular level of looking at a specific stock, no analyst would look at Apple in isolation. They would be looking at supply chains, competitors, they would be looking at trend analysis in terms of device purchase, etc. So, front to back, an analyst is looking at Apple within its ecosystem. And I think then you step that out to the sectors rubbing off against each other as part of their ecosystem, and a PM sitting over the top of that, looking at everything on a relative basis, stocks on their relative basis, sectors, etc., markets, if they're going across markets, etc. And then I think so what does that actually mean for the conversations and for how decisions get made? It is about these disparate conversations with very, very different people in different parts of the world to round out your view of an investment, of a stock, of your portfolio structuring. It is to think about in today's world, where imbalances are happening in the system. I worry about the number of buy recommendations that there are on the FANG stocks. It just screams to me. I look at market breadth at the moment, and I just look at, certainly since a couple of months ago, the number of stocks that are above their 52-week highs relative to those that are not. It's only a tiny number. Market breadth has massively shrunk. So it is thinking about, yes, this is a good investment from a metrics point of view, but what's the context, and how am I actually going to get line of sight on what's happening from a contextual point of view? So that means, the equity guys sitting in the equity bubble, they are going to die. They have to be talking to the multi-asset guys within our firm. They have to be talking to fixed income. They have to be analysing stocks in partnership with their credit analysts as well. And it is that more collaborative, collegiate, almost mirroring across the capital structure investing, even if you do invest in just one part of the capital structure. The lens is different.
I guess, as we said earlier, this is where the incentives and the KPIs are very important, because you've got to encourage people to behave that way, because historically it probably hasn't been natural for many investment firms to organise them in such a multidisciplinary, collaborative way. They tended to specialise in different areas. But it's interesting how things are moving much more towards generalists in some ways. I think we need specialists, but we also need generalists as well.
Yeah, and it's called the T structure from memory in terms of expertise that you need a business. You need a number of people that can go across the top, and then you'll need a number of people who can go very deep down into particular topics. But you kind of have triggered, something for me in terms of, if I look at our clients, major industry funds, superannuation funds, there's a lot of friction in the system for them as well. And that's actually reflecting back into how we structure our businesses in asset management. So if you think about it, let's say a normal superannuation fund here has a stated objective of, let's say, CPI plus 4%. And really should be approaching investments on a total portfolio view. So with each allocation of money, what does this, either strategy or asset class, what function does it perform inside my portfolio with this total portfolio lens? And I want to stay fully focused on the CPI plus 4% outcome. Yet you think about the organisational structure as it stands today. I've got a head of equities, a head of fixed income, a head of real estate. I might have a head of alternatives, a head of PI, whatever. And you have the silos still existing under the cover of that objective. So there's friction inside that system. And where we should be pitching our offerings, be it intellectual property that's embodied in a strategy on the basis of, this is what this, let's say real estate, an allocation to our real estate fund can generate you CPI plus, let's say, 2% or 3% over the long term, and therefore can fulfill a function for you, we're still being forced to face off to the real estate guy. So what I've noticed with a number of funds here in Australia, and I think it's a fantastic evolution, in part it's the adoption of the Tars Watson total portfolio thinking, where yes, you have your silos, but you all feed into a total portfolio lens, share ideas. If a particular investment idea is coming up, let's say through Oz Equities, is there anywhere else that we can also harvest returns from the same thematic elsewhere? And so you align these heads, if you like, via their incentive structure to contribute to the total portfolio view. That evolution is improving our ability to face off, as in asset managers' ability to face off to clients, to offer our intellectual property, you know, because we actually mirror our super funds. We have capital markets assumptions, we have strategic asset allocation, tactical asset allocation. We get to express our views in multi-asset portfolios, much the same as a super fund. But we can offer all of our mechanics as IP, as just information sharing to our clients. So I think that evolution will accelerate the collaborative working inside asset managers, and that can only be a good thing.
It's interesting to see that progression happen with some of the larger funds. What do you think is causing them to do that? Why now?
Why now? Because they're worried. So if you think about the last 10 years, it has been phenomenal in terms of returns. We haven't had that many speed bumps. I mean, drawdowns have been absolutely tiny throughout that period, maybe a little bit in the taper tantrum in 2013. But there's been no pause for breath. The interesting thing about this bull market run that we've had is it's felt really bloody miserable, to be perfectly honest. Nobody has felt confident. Nobody, like, it hasn't felt in markets like we've all run off, you know, to the races, thought we were rock stars and we're set.
Kind of looked like that in January a little bit, and then it pulled back.
Yeah, and I'm saying that in the week after Apple went over $1 trillion. But certainly in talking to investors, you know, there's been a healthy level of fear all the way along, but there's been an acknowledgement that, you know, cannot see, most of us as investors can see the reason for markets to run out of steam because we're overextended from a valuation perspective. But can you see, you know, a confluence of factors that will cause a bust? And that's really, really difficult. So we're staying invested, but we're white knuckle riding now. And I think the super funds in particular, you know, I mean, you're looking at some here in Melbourne, Host Plus, like double digit returns last year. They know that that's not sustainable. It just is not sustainable, but we're in it as long as the ride is good. But I want to have my reserve positions well thought about and my structures in place for when markets turn. And that, I think that's incredibly healthy.
I would agree that definitely anticipating a low return environment has driven this focus towards whole of portfolio approach. I think there's another thing happening as well, and I think that's just that funds have gotten to a scale where having the silos just doesn't work. Finding another Australian small cap manager.
Yeah.
Where are they going to find one?
Capacity. Yeah.
If they find one, they'll take all of its capacity, and it will have an immaterial effect on their returns because they're now so big that who cares? So it's kind of forcing funds to think and make their decisions at the higher levels, at either the sector level or the country level or the asset class level.
Yeah.
People paying more attention to dynamic asset allocation. They're also looking more at co-investment or using factor strategies that are larger and liquid. And I think a large part of that's just scale. They're just, and this is something that I'm looking forward to discussing with a future guest very shortly. Be interested to get your views as well, is at what point does a fund become so big that things like stock picking start to become
irrelevant?
Irrelevant, yeah.
I don't know. I look at, peers internationally. I look at CalPERS at 300 billion, and they're still generating outperformance for their memberships, for their client base. So, we've got a distance to go before any of the Aussie funds hit that. But that said, the level of growth that we're experiencing, it won't take us particularly long to get there. They are being particularly ingenious in terms of how they harvest intellectual property from asset managers like us, how we transfer, our know-how across to them, and how they can actually learn. And then if they see particular strategies like signaling portfolios, etc., working, they may want to extrapolate that across their total asset base. But I think they are in particular are quite ingenious in how they use the street as in asset managers. And I know for a fact a lot of Australian superannuation funds and industry funds, already talk to their counterparts overseas, Canadian pension funds, European sovereigns, etc., to learn, because we're moving into the zone where we've got a very firmly established, fantastic asset base here, managed by really, really good investors and managements within the funds. But we are stepping into the realm of really, truly owning long horizon investing. And that's because, to your point, the shorter term allocations to Oz equities, etc., is only going to take us so far. The lens is shifting to generate long-term returns, especially as the demographic starts to shift and there is a liability on the other side. It calls for different thinking, and you want to be getting your stall set up now. You want to get the investment expertise in. You want to be learning from others offshore. We don't have to learn everything ourselves, so we can look and see what's worked for other markets, and we can adopt that here.
Mm-hmm. I have to ask this question, obviously, given that you're working at Fidelity, and Fidelity is a huge global organization.
Yep.
We often hear institutional investors talk about having a preference for smaller boutique managers. Obviously, you have a different view because you work for Fidelity. Tell us, what do you think they might be missing when they form that impression?
So from Fidelity's perspective, if you just applied, I guess, an AUM metric and filter over the top to choose an asset manager that's your ideal asset manager, and you had a cap at a certain level, or, let's say even if you went to a granular level and said, I don't want any firm that manages more than X in global equities, what you would be missing with Fidelity is that we have no one size fits all. Like, we have a smorgasbord of individuals managing portfolios, how they want to manage portfolios. But if you were just talking about the equity space in particular, there is a commonality in that most would be bottom-up stock pickers, because that's the DNA of Fidelity. It is based in research, analyst research, etc. Obviously, fixed income, completely different, although we have 50 credit analysts. So I think you would miss that piece. And there is, I can't think of many of our portfolio managers across all of the assets that are particularly similar. If we were just to look at, let's say, Fidelity Investments in the US, one of the funds which gets a huge amount of press is Will Danoff's Contra Fund, right? So we're at close to 140 billion global equity fund, great returns for investors. But he would have a peer in Jeremy Podger, who manages global equities for Fidelity Investments, who's capping himself out at 10 billion. That's where he thinks he can generate alpha for clients, and Will Danoff is different. So these individuals, are absolutely well within their rights to do that. Jeremy Podger runs his fund his way, and he thinks there would be alpha degradation if he goes much bigger. So within Fidelity, you've got individual factories, you've got, people who behave as boutique managers. You've got Paul Taylor, who runs a sizable Australian equity fund. There's criticism levied at us in terms of the size through there. But if you want skin in the game, there's a gentleman that has 100% of his superannuation in his fund. So he feels all of the pain and all of the glory hand in hand with clients. You would miss that if you just had a AUM filter across the top.
I think that was a a fair response. So I'm going to hit you with another devil's advocate question now. I'm not going to let you off the hook yet.
No, that's fine.
Are large global investment managers really the asset gatherers that they're often accused of being? Will you launch any strategy you think can gather assets? Is that what the game's all about?
If we were purely about asset gathering, we would not launch small cap funds, right? We would not be launching low carbon bond funds and quite bespoke strategies like that, because the cost of that, the cost of supporting an analyst through our system into becoming a PM through PM Academy, baking that guy, through a process of, a pilot fund before going live. Then in the Australian market, it being so gatekept, getting them another 3 years to get track record to get rated, etc. The sunk cost against those individuals is absolutely huge. And if you were purely looking at it from an asset gathering perspective, you would say no to small caps. You would say no to funds that could only raise 2 and 3 billion because the commercials wouldn't make sense. So we certainly don't do that. We don't have this asset gathering lens. Now, that said, let me talk about passive plus active. And, I am a passive plus active investor. That is my approach also to our business. I believe passive is superb for the end client. I think it is absolutely a healthy counterweight to active management on the other side. And why do I say that? Because it is forcing a hollowing out of the middle ground. If you are going to survive as an active manager, you will have to prove to clients that you produce idiosyncratic alpha that cannot be replicated by an allocation to either passive or a smart beta. And that can only be in the client interest, because therefore that hollowing out process, you either pay a very low or no fee for your beta, your passive trade, or you pay up for active management on the other side. And Fidelity is an active plus passive house. We have both. We're known, especially in Australia, for active management. If we're solving problems for clients, let's say we have a super fund come to us and they want to inflation proof their portfolio, which we've worked on. If we need to make, or it's, economical to do it, we make allocations to passive plus active. We will package that up. They are instruments to be used to deliver an outcome for our clients. And in that, I guess we become agnostic to the passive plus active. It's what packaging, what basket of instruments, etc., delivers for the client. Where I do think we have to be very, very careful is all ecosystems, healthy ones are in balance. And I do worry that we've had this huge growth in passive. It's massively accelerated, since 2003, and that we potentially have an imbalance in the system. That imbalance will right itself, and there will be a settling down and then a move forward again.
It's interesting to hear you talk about active and passive being used together. The way I've always conceptualized it, and it's a very simple example, is to use them much as you'd mix cordial. So you've got the water that's free, you've got the concentrate, which has the flavor which you buy, and you mix them to taste.
Yep.
And often I find that actually in constructing portfolios, it gives you another lever to pull, because you can adjust the level of active risk to suit what you're trying to do, exactly, rather than pay a manager to do it, which generally ends up costing you more.
Yeah, agreed.
It's interesting, though, it's often very hard to get people to think of it that way, because they see taking that risk management in-house as not being something that they necessarily want to do. In some cases, they want to outsource that to the manager, but I do think that's changing somewhat.
Yeah,
I think a lower return environment and a need to be competitive is, it's forcing people to think about that some more. So you've kind of touched on this a little bit, but what do you think active management will look like in the future?
I think in the next 5 years, the cream will rise to the top, because I don't think there's anywhere left to hide. Our conversations, and it's us going front foot when we go out to our clients and talk to our clients, us wanting to prove that our portfolio managers have skill, and that it is idiosyncratic. And that places us, if we can truly prove it and you get buy-in from the client on the other side, the persistency of money that comes in to those strategies should be very, very high, because we should also, along with generating returns, we should also be able to be very transparent as to when a portfolio will perform and when it won't. And all portfolios go through periods when they don't perform, right? For a client, giving them comfort on how a particular strategy and a PM will behave under certain conditions allows them, on the total portfolio basis, to solve for that. And what you definitely don't want is a portfolio manager changing spots, you know, and switching around on you when clients have allocated. So to my mind, the idiosyncratic piece, the true skill piece, ultimately leads to a better persistency. I think the fee debate changes in turn, because the actual value for money that you're seeing, I think in part because we had benchmark huggers, we had Me Too, we had that middle ground inactive, you know, a lot charging very, very high fees. We left ourselves open to the decline in fees. I, looking at the market, feel that's bottoming out, certainly on an institutional level. And there is an acknowledgement of the value of active management, and therefore what individual clients are willing to pay and how they use up their fee budgets. But if I looked, you know, beyond the kind of the 5 years, you get the cream rising to the top, and you get a level of harmony, I hope, with passive. I do believe that we probably, from an investments point of view, move much more into investing across the capital structure. I still don't understand why, if I want to generate returns, let's say I'm an equity PM, that I cannot buy the hybrid or I can't buy the bond if the company is being run for the bondholders. So I think those type of cross the capital structure style investments will probably grow. To your point, it probably will take a period of lower returns and the requirement to harvest every single basis point towards a CPI plus objective as the driving force. And having a research base that can support that will be really important. If I was to look 10 years out, my view is, and I'm asked questions on this all the time, around technology companies becoming asset managers, you know, and why wouldn't an Amazon, an Alibaba, etc. So bearing that in mind, I think that they won't necessarily want to become asset managers, but they will become a distribution arm for us. And I think Robo is the start in that direction to a degree, and their client acquisition, obviously, you know, is fantastic. But asset managers will provide the back end. We will provide the engine room. It will just be a different route to market, which will be appropriate for a specific cohort.
Mm-hmm. It's funny you mention tech companies moving into finance. I believe they probably could quite easily, and I'm sure they've thought of it. But I don't think they want the regulatory scrutiny that will come with it, particularly when you see things like Google getting fined in the UK in the EU for anti-competitive behaviour, and if it has to comply with EU financial regulations, that would be a nightmare for them. So, but it's interesting, and I'm sure there are people beavering away inside of Google and Apple right now, using their search tools to do all sorts of investment things. Maybe that's sitting somewhere in the other bets portfolio.
Possibly, hidden away from the public markets view
that we don't know about. So you touched briefly on fees and the pressure on fees to sort of squeeze everything out given this low return environment. What can fund managers do to offer their clients more value for money other than just lowering the fee?
So my view is that in terms of servicing clients and in today's selling today is a mix of product placement and client servicing. And we no longer flog a product or a strategy. There's no value in that. There is an offer of strategies in order to achieve particular outcomes. But more important is the service that we provide around that. And sometimes for, let's say, clients here in Australia, our company in the US, 50 million accounts, their digital marketing and their ability to use data down through years, they have, succeeded in client engagement via the digital channel, if you like. It's just absolutely phenomenal. It's really, really powerful. So what we offer to clients here is the option to go to Boston and learn what we do with our clients in the US, because member engagement is a huge issue here. So a lot of superannuation funds doing terrifically well on the investment side and massively disengaged membership. So how do they bridge that, especially before going into the whole retirement piece? They need to solve for that engagement to get people lined up for transition and then engage with them in retirement. So there is transfer of expertise and knowledge and I suppose a much more open door policy around intellectual property. I think that just becomes the norm, quite frankly. Today you could say it's a differentiator depending on what expertise you can offer, how you can offer that. But really, if you're to do it well, how many of those partnerships could we have here in Australia? 5. If we are to really transfer our IP across to clients, have a multi-layered conversation at all levels in the organisation, there's probably very few that we could truly service. So, you need to find your ideal partner as well. So we need to find our ideal client, and Super needs to find their ideal asset manager partner. And that's a bit of trial and error on both sides, quite frankly.
Mm-hmm. I think that's an interesting point, that large fund managers, particularly fund managers with a large and well-established retail business, whether it be in the US or another country, have already solved a lot of the problems that funds will need to solve as they become larger, and also as they move beyond the particular interest group or industry group where their fund started.
Yeah.
Because it's easy to keep in touch with everybody when you're in the same industry or in the same zone.
Yeah.
But when you're starting to extend beyond that, it becomes a bit more challenging. So I think that's an interesting idea. And I was going to ask you, why do you think we haven't seen a lot of innovation in post-retirement up until now? And what is Fidelity doing on the post-retirement front here in Australia?
Yeah. Well, in part, it's the demographics, because we're just reaching a point where the numbers going through to transition and into retirement is growing, and the delta on that cohort is starting to extend over the delta on accumulation. But we will be in accumulation for a long period to come. I think it's really based on Deloitte's research, 2036, when we hit the Rubicon and cross over. So more retiring than more coming into the workforce.
But you've got to look at that a little bit more deeply, in that most of the accumulation is only really going to a handful of funds.
Agreed.
So the vast majority of funds by number, if not by size, are already at or close to accumulation.
I think the focus on post-retirement, to a degree, we're still an equity country. And I think, most investors still like to have their share account with their stockbroker and want to be invested in equity markets. And given, it's almost as if the Australian population kind of decided to solve for their own mortality or longevity risk by staying invested in markets and staying out the risk curve. So I think that the willingness to take risk has probably been part of it. I do think, though, as we discussed, the heady days of the returns that we've seen over the last 10 years, they have to end, and therefore drawdown risk, in particular, preserving capital, either going into retirement or during retirement, becomes way more important. I do think that to a degree, we have been insulated from the GFC here in Australia, apart from, if you were exposed to, US stock markets and you had that 50% decline in 2008, the level of insulation that this market, both economically and then from an asset price point of view via real estate, etc., probably kept the monkey on your shoulder of risk and the risk of permanently losing capital away. So the focus on, well, what do I do in retirement when I can't afford to lose money, where I have to make my money work for me and generate an income because I'm not earning, that kind of, impetus to change and make decisions in a different way wasn't there. What I do think that we've got here is an opportunity for a small country in a big hurry to learn from overseas markets. So we can look at the experience in the US. We can look at Europe, where there's been unfunded liabilities for ever the longest time. Those have been on company balance sheets, which of course we don't have because of our superannuation setup. But we can learn from how they've solved particular problems in those geographies where we've had, let's say, local government authorities with negative cash flows, unfunded liabilities, the absolute worst type of pension problem to have. We can look at Japan. We, Fidelity, have decumulation business there where you're trying to solve for longevity risk ensure people have enough money in retirement. So I think we're in a great position to take the learnings of overseas. Then how do we do it? Going and picking something that worked offshore and plugging it into the Australian market would be absolutely the wrong thing to do. So I've been with Fidelity 4 years. In my role before taking over running the business as an investment specialist, investment director, I thought the appropriate approach for us for retirement would be to launch a global multi-asset income fund. Makes sense. We need income. You need to be using assets all over the world to generate that income. But that was very one-dimensional thinking on my part. That kind of one product solves all. And luckily, I changed course, and I changed course because I talked to people in markets. I went to conferences. I listened to challengers speak. So we have hired a head of client solutions and retirement, Richard Dinham, who was the CIO and then head of research at State Plus, one of our large super funds. And Richard's job is to design retirement for Fidelity. Design what that looks like and begin to build a business for us. And how is he doing that? He gets to sample all of the building blocks across Fidelity, both from the US and Fidelity Investments from Europe down through Asia. And he gets to go out and talk to the market on what's appropriate for this society. Also to think about, on a 5, 10, 20-year view, how are people going to behave? What will they be spending their money on? What will healthcare costs be on the other side of that? And so the modelling that will go in to our approach to retirement, I hope will be, quite granular and very broad-based. And then we will be working with market participants on how we package that for various cohorts. But one of the things that I would say we cannot solve is those that are fronting out to the end client, be it a super fund with member engagement or be it a platform and an advisor through to the end client, is risk profiling is dangerous. It is one-dimensional and it would put investors probably at their most vulnerable into the wrong portfolio. And my view, and it's a personal view, is that we need to move into 3-dimensional approach to our clients, where we are looking at 3 things: risk profiling, what the objectives are, and what the total portfolio view is. So an individual coming in could have their own house, 2 investment properties, and maybe a term deposit. They don't need more income. They need probably growth and a little bit of risk in there. By taking into account those factors, collating that information somewhere, be it on a super fund's, portal, be it on BT Panorama, whatever. It's not for a Fidelity to do, but we need to plug our offering in to that system. So in us being very public on what the evolution looks like towards good retirement offerings in Australia, we definitely want to bring our partners with us on the journey. because if we move together and are aligned, then the outcome for the end client is going to be so much better.
I couldn't help but think, as you were describing your vision of the future, which I think is probably what's going to happen, in that we're going to have to take much more of a total or holistic view of people's needs, objectives, their life balance sheet, their assets, is that's going to be a massive culture shift for superannuation, because superannuation has, for all of its history, been built around the collective, been built around let's pull it all together and grow it. And what you're describing is essentially, well, let's understand each individual and their circumstances, and almost mass customization, I guess. Yeah. We build the building blocks, but we assemble them differently for each person. And that's a pretty big shift in culture from how super has operated up until now. I'd be interested to hear your views on how that shift might take place. The only thing I can think that might help it is technology. But
Agreed. And it absolutely is that. And I think that's why I'm not frightened or worried by Robo advice. I think this is great. It brings advice at a level to clients who may not have accessed it. We just need to get everybody into the mindset that they do need outside expertise in order to get their investments pointing the right direction and solving for their lifestyles and their problems. So there's a couple of different things. The super funds have their member data. They are moving towards using that data much more efficiently and appropriately. And if that data was interrogated through time, especially for those that have had members move into retirement, we probably would get a great lens on the needs here. But again, we can adopt technology that's been used elsewhere, be it, let's say, I'm thinking about things like Fidelity Investments in the US. So our digital portal, Fidelity Go, for our investors in the US, based on what clients are invested in, but also what they're interested in, what queries they've come through, etc., where they are in their life cycle, what else they have in their portfolios with us. Our systems can suggest a list of the top 10 things they should do with their investments to ensure a healthy future. 10 things is too much for anybody to take on board. So while it would give you a list of 10, it gives you the next thing you must do, the next decision that you must do as an investor to remain healthy, etc. So I think, that type of technology is there to be used. I think we're a little bit away from that currently, whether that's with the super funds or it's the platforms or advisors on the other side. But once, the transition begins and apps actually make it easier, we'll move. The interesting thing to me is looking at super funds, and where there are some that actually have the company advisor ratings on their websites, where members can actually go and check out which advisors are highly rated. And at least there's a beginning to link up where super funds do want their client base to be advised. So the advice mindset, zeitgeist is beginning to come in. And I just think that's an interesting development when you've got the Royal Commission blowing apart vertically integrated advice models. Yet we know there absolutely is a place for advice, and we know there is a value to advice. Where advice ultimately sits inside an IFA, a dealer group, on a platform, etc., yet to be seen. We have our views. But moving towards what's in the best interest of clients, I think we're moving very speedily towards a good outcome here in Australia.
Let's hope so. Let's hope we finally shake off the legacy of insurance sales, which is really where a lot of advice started, and much of the culture is still similar to selling insurance products. So hopefully we can move past that and be much more objective oriented and more client oriented. So wrapping up our chat, I've got an idea what you're going to say for one of these already. That's a question I ask most of my guests. What are 3 practical steps that investors can take to improve their investment decision making?
Outside expertise.
I knew you were going to say that.
Every single one of us, including market participants, and it's a little bit like the tradesman, the carpenter whose kitchen doors are hanging off at home. even those of us in financial markets don't necessarily do a great job of looking after our own financial affairs. I think, the value of advice in not just what investments to choose, but the packaging of those investments for a particular outcome, but also estate planning. We're moving into a phase where the depth of wealth has grown for such a young economy. I mean, we're less than about 200 years old, and haven't had to go through enormous, busts and booms, but we've developed a very rich 2.7 trillion asset base. We will be moving into intergenerational wealth transfer, and we are going to need that because people are going to be living longer. So you think about Japan, those that are coming up to retirement now that don't have enough money, their parents are dying, so they're at 65 and their parents, dying or, in the next 5 to 10 years. That transfer of wealth is necessary for the health of Japanese society. And I think, in the US, you're beginning to see that as well. And we will come into that in Australia. And, I don't necessarily know that we pay that due attention here. So that's number one. So how many were you looking for?
So 3. So you mentioned talking outside your field or your area.
Yeah. So definitely that. I think diversification. So, it's great to have a winner, whether that's a stock or it's a portfolio manager or it's Fidelity Australian equities, etc. But you need to have, diversification, especially as, you're coming up to retirement, to hedge against risk and downside risk in particular. You need to be very, very careful of the correlations, though, or the layering of risks, because having your own home in Australia and then having 2 investment properties and then buying bank shares for dividends is not actually diversifying your risk. You now have, 3 to 4 warrants on the Australian property market. So just be careful that because you're different asset classes, that the underlying risk, if you like, is not the same one. And the third one is, if you don't understand something, stay away from it, right? I sit and think about the GFC a lot at the moment because I'm being asked an awful lot of questions about it. We're coming up to the 10-year anniversary, and have we learned all the lessons really that the GFC taught us? And I'm kind of going to go full circle here, where I go back to my genetic engineering background. You cannot legislate against human behaviour. So we have got great breaks in the system now because of the GFC. So we had Basel I, which had capital adequacy ratios for banks. And because then the GFC was precipitated by housing, etc., we now have Basel II, which mandates you can only have a certain amount of risk on a bank balance sheet from one area. And so the legislation is basically coming in to protect humanity from itself, but it can only go so far. And we all get caught up, in the next big thing. And I just think about Bitcoin. If people ask me, have we learnt lessons? I just look at Bitcoin and say, obviously not. In part because I don't understand it. I understand the technology in blockchain. I think that's got legs. I think it's amazing. But I do not understand Bitcoin, and I don't know how you value that. And yet last September, we had over 400 million US flow into Bitcoin. Now, I look at last month and that was only 60 million. So you can see the head of steam coming out of there. But if you don't understand something, then even though it is the next best thing at the moment, my advice is stay away.
I think there's some excellent tips there. Alva, thank you very much for your time. It's been a pleasure chatting markets with you.
Okay, you're very welcome.
Thank you.
Thank you for listening to the i3 podcast. For more information, please visit www.i3-invest.com. Thank you very much.